So without further ado, join me in welcoming Noah.
Good morning. Thank you for coming out. First thing in the morning. Hopefully I can keep your attention for an hour or so talking about fertilizer. Hopefully you haven't exhausted your interest in fertilizer after the last 3 years. Yeah, I'm Noah Bishop. Thank you for the introduction. I'm a product line manager at ADM Fertilizer. As I said, I look after urea specifically, so I have a key interest in nitrogen. Today, though, we'll do a brief introduction to ADM because it's important to understand who we are and what we do. And then also we'll move into a little bit of discussion about how the fertilizer market works, how it trades, so that you have an understanding that when we start looking at a forecast further out in terms of price, you understand how we come to a forecast and how we can start to think about the way the market is going to move as we move forward into spring and into the back half of this year. So without further ado, ADM, obviously you've probably heard of ADM, over a 100-year-old company, relatively large. We have a pretty big global reach, which gives us an edge in terms of feeling what the market is doing in any region around the globe. We've got contacts and offices right across east of the Suez, west of the Suez, so we have a pretty good feel about what farmers are doing on the ground, how agriculture is working, how the trade's working, how vessels are moving, this sorts of thing. It gives us perspective outside of just being, a Canadian or a U.S.-based fertilizer distributor. ADM in Canada, our Canadian footprint that you would be most interested in as far as fertilizer goes is obviously Saskatchewan, Manitoba, Alberta. We've got, as far as fertilizer assets, we've got an asset southeast of Regina, LeJord, one in Yorkton, one in Carberry, and then one near Lethbridge, just south of Calgary. So who is ADM Fertilizer? This is our North American terminal map of fertilizer terminals. We have 11 locations connected to Grain River terminals and significant warehouse capacity. Really, the business started, it's quite simple. ADM was predominantly, obviously, a large grain company in the U.S. We're exporting a lot of grain on barges down the Mississippi River, and we have all this freight that we're giving to other companies coming back northbound on the Mississippi River. And instead of giving that freight away, we thought, how can we optimize this northbound freight? And what is a product that our farmers need? It's fertilizer, right? And the U.S., as we'll get into, is a net importer of fertilizer. And so really the business started around importing fertilizer. It's obviously grown from then to originating domestically and we're working some stuff internationally as well. So really the core of our business is the Mississippi River. Obviously we import into NOLA. I got a slide here. I say unparalleled fertilizer logistics capability. And really that's because we import into NOLA. We can push barges up the Mississippi River to our river terminal locations. We can put those barges into rail cars, then we can rail into Western Canada. And so the neat thing about ADM is we might buy, say, a boat of urea out of West Africa, and we might be the only one to touch that product from when it leaves the plant in West Africa all the way to your farm. So we're vertically integrated all the way from chartering the vessels to stevedoring capacity in NOLA, transferring it to barges, pushing the barges up with ADM's owned barge line company, ARTCO, putting it into our river terminals, transloading that into rail cars, unloading the rail cars into our terminal, and then shipping those tons right to your farm or to your local retailer. So it gives us a unique perspective and innate control over logistic flow of product from origin to destination that's unique, and it gives us optionality that if we see a better price internationally for product than we see locally, we can go and source that product and realign market structure, and vice versa. If the domestic market is cheaper or more attractive, we source product obviously locally as well. So really the vertical integration of our logistics capability is quite frankly second to none, especially as a Canadian distribution company. So how does our model differ from the traditional retail? There's a whole host of reasons here, but there's really just one I want to touch on. It's our price transparency. And really that's because when I'm out talking to international traders on urea front, or our phosphate traders talking to people on the phosphate front around the globe and domestically, we have a direct line of conversation with our salespeople, the people you're interacting on the ground, the people you can pick up the phone and have a conversation with. We're a relatively lean company, so we have a direct line of conversation to all of our salespeople that allows you to get information, only one order removed, rather than playing a game of telephone that you might be with your other suppliers, where the information gets disintegrated and maybe fuzzy. We have an app where you can go and see prices. Really, the premise behind our app, the pricing that we put on our app, is that is our market, how we price fertilizer in the first place, which is replacement pricing. And I have a slide, and I'll touch on that in a minute. So global fertilizer market basics. It's important to understand how the trade works, how global fertilizer trades, in order to understand how we derive market direction. Fertilizer is a globally traded commodity. There are origin points and destination points all around the world, and quite frankly, the US and Canada are really just a small piece of that pie. And so understanding that when we're talking about urea, it's bigger than just the domestic producer in Western Canada. It's really important to understand that, because otherwise you'll get misguided in terms of how the pricing works and how the market derives its price. So there's several global liquidity and exchange points around the globe that we refer to. We've got our FOB Arabian Gulf producers, and most of these are more specifically focused on nitrogen, but other products as well. So we've got our FOB Arabian Gulf producers. Those are your Saudi Arabians, your Iranians, your Oman, your UAE producers. That's obviously a cheap area of cheap natural gas, high oil production region, and so they have a relatively low cost of production. They produce a lot of product. That product typically flows east and west, so that product might flow, say, over into, I think I got a pointer in here. It's pretty small. That product might flow over into India for Indian consumption, or it might flow over into the US and Canada for Canadian or US consumption, so that product really splits across the globe. Then we have our Baltic production. That's really just Russian production that either comes out of St. Petersburg or it comes out of the Baltic Sea. And again, that typically flows into the US and Canada, or not Canada, that typically flows into the US, to South America, and into Europe. That's a relatively large production point around the globe. We have our FOB NOLA, and this is the most important one for Canadian producers or Canadian market pricing. That's our FOB New Orleans, Louisiana trade point. That's the main entry point for fertilizer that's imported into the United States. We have our CFR Brazil market. Obviously, Brazil is a big market, like we'll talk about in a few minutes, and plays a meaningful role in us determining price direction. When we think about the spread, is Brazil trading at a premium on a particular product or a discount on a particular product compared to the US? And then we have India, and India is a huge market, especially on urea, that we'll touch on later as well. Urea and DAP have futures markets, so there are futures markets on these products. They're financially settled derivatives. They trade and clear on the CME, so if you go on your phone, you can look at the CME, you can see what urea paper was trading for yesterday. These markets are relatively illiquid, and there's still a lot of over-the-counter trading that goes on in these derivative markets, so sometimes there is a gap between what's traded on the CME platform and what's actually trading, because some contracts are getting traded just dealer to dealer, i.e. me picking up the phone and talking with a trader and transacting quietly. But what that futures market really allows us to do is it allows us to hedge physical purchases. So we can procure product today without price risk, put it in our terminals without price risk. So when we see a market structure that perhaps is uncertain in terms of price direction, and we're worried about loading up and say buying a bunch of urea, we can forward sell that on the futures market, just like you do with your grain. It's the exact same premise. So the market hedging is a really unique component, but also what the futures market allows us to do, it allows us to see the future price. And so that's what's allowed us to go out to the market, as if you know anything about it, as we offer forward price on fertilizer. The paper contracts has allowed us to develop a forward price. So you could call up your ADM sales rep and say, hey, it's January now, I want a price on spring urea, what's your price? And I know there's other competitors that offer that, but we would even go as far to say, hey, we'd offer you a price on December of next year, hypothetically, if you'd want it. So the futures market gives us price transparency forward. So New Orleans, Louisiana is the most important to Canada, and that's because that is the entry point of fertilizer into North America. Most of Canadian fertilizer that is imported into Canada is imported through the US.
So it gets brought into NOLA, then shipped up the Mississippi, like I said, and into Canada. So whatever that NOLA point is trading, that is basically the replacement cost of the import or global market for the Canadians. And domestic producers will set their price based on NOLA, not on cost of production. So if you're thinking about, say, nitrogen, how is nitrogen price set? You might say it's set off natural gas. It's only set on natural gas at the margin, not in, say, the US or Canada, because we have very cheap natural gas, relatively low cost of production, and so there's no need for the producers to set price that low because they're competing against producers around the globe that have much higher costs of production. So we can set prices in Canada can be set just high enough that imports don't overwhelm the market and the domestic producers can't clear their tons. So again, the domestic, even if we have domestic production of potash or urea, which we do, or AMS, it's still set based on the global market and what can compete with that domestic production, which all relates back to NOLA pricing. So there's the NOLA market trades in US dollars a straight ton. So to convert that, it's very simple. You just take your NOLA price, you add your basis, which is basically your transportation freight to bring it from the Gulf up into Western Canada, and then you multiply that by 1.1023, and then by the US dollar exchange rate. So CAD to US dollar. So that means that there's three drivers of Canadian market pricing on fertilizer. There's your underlying commodity market, which is your NOLA pricing, which is what most people care about. Others forget that there's other impacts too. There's your basis, which is your transportation costs, and we see varying factors across North America that impact our basis levels, if it be supply and demand of freight, if it be issues on the Mississippi River, and we can get into that as well. And often that's overlooked, right? Sometimes we see declining NOLA markets, but the declining NOLA market becomes disconnected from Western Canada because the basis is widened up because of transportation issues. So that's important to take into account. And then obviously the FX buying power, and that's really what partially correlates your fertilizer movements with your grain movements, right? Because obviously if you have a stronger Canadian dollar, that's typically going to put pressure on your crop commodity pricing, and it'll also put pressure on your fertilizer pricing because that Canadian dollar buys more. And so that really aids in the correlation that you typically think about when you think of fertilizer and grain. So the Mississippi River affects basis, like I think I've burned through a few times. It's a very key waterway for importing products into the U.S. And so the ability to transit that waterway dramatically impacts basis levels and thus Canadian market pricing. Over the last year, we've had a very challenging Mississippi River water level situation. We've seen significant drought across key areas, specifically on the lower Mississippi. That's led to us having to transport lower or lighter barges that cause a higher draft, so they don't sink into the water as much and don't bottom out. Those lower barge drafts obviously mean we transport less product and increases our barge freight. It causes slower moving of barges, so the cycle time moving product from A to B is slower, and that's also increased by having to use smaller tow sizes. I'll tell you today that the Mississippi River is functioning relatively well. We had a number of issues before Christmas time, specifically transiting the St. Louis, Missouri area, getting into docks there. The river was at a 50 or 60-year low, very challenging, that was going to start to put significant pressure on the basis. Since then, over Christmas, that Inola, Oklahoma, Missouri area got a significant amount of rainfall and actually snow that's put a significant water bump into the lower Mississippi River. That's allowed us to resume loading barges or loading rail cars and getting barges into the docks there. So for the time being, this situation has improved, but I think it's very important to understand the impact that a fall or a dramatic change in the ability to transit the Mississippi River would have on Western Canadian fertilizer pricing. So does NOLA drive Canadian fertilizer? I think I've worked through theoretically why that makes sense, that NOLA changes the Canadian fertilizer prices on these products. But here's just a numeric example, if you will. StatsCan urea or fertilizer pricing nitrogen index against NOLA urea average. High degree of correlation. For various reasons, at times the correlation breaks, and that's mostly to do with your change in your basis or your basis risk. So what drives fertilizer pricing? a number of things. There's supply and demand reasons on both sides. We'll get into a few of these. Farm gate profitability obviously is a huge one and something we take very seriously. Typically, this is proven by looking at the correlation between crop commodity prices and fertilizer prices. Expectation of price direction, macroeconomic variables, all of these things at various times drive fertilizer market pricing. But the really important thing to understand is multiple variables set market pricing at different times. So you can't take one market variable and look and what we would call a univariate analysis. You can't take one variable and say this variable has changed, thus the fertilizer market will move this way. Different variables come into play at different times. Oh. Lost my slide. There we go. And that's really what this graph is showing. So this is, and I apologize, this is labeled wrong on the bottom. This is the corn to urea ratio correlation. This is the DAP to corn to DAP correlation and the potash to corn correlation. And this is a rolling correlation. And really what this graph is showing that sometimes corn prices do impact urea pricing. And sometimes they don't because other factors come into play. So we might have a declining corn market, but we might have major gas issues in Europe that cause significant up pressure on cost of production. And so you can have a diversion in times where you see a falling commodity board and people want to say, I'm not going to buy fertilizer because the price is going down because the commodity board is falling apart. And sometimes that's true, but sometimes it's not. And it's really important to understand that you can't perform a univariate analysis on a market that is complex and has different variables that pull into the pricing structure at different times. So that's really what this graph is trying to demonstrate for you. So we'll get into a market update, try and give some context around fertilizer markets. I should have put small print up here like you see on the investment presentations that say returns aren't guaranteed or something. Obviously, this is our take on the fertilizer market. We're not always right. We're normally right, but we're not always right. No. So the potash market has been very interesting. Obviously, we all know that potash prices increased substantially from 2020 through to 2023 due to a variety of reasons, not least of which the Russian-Ukraine war that put significant concerns into the market about getting Belarusian and Russian product out of the country. What we've seen over the last 2 to 3 years, this really high market pricing has absolutely destroyed demand. And we've seen that at the same time that the Russian producer, the Belarusian producer, that we were concerned about getting potash out and exported to the rest of the globe in the first place, they've been relatively successful still accessing the global market through Lithuanian and other export points. And so you sort of had this double whammy effect where the market mispriced the supply availability, meaning that they thought the supply was going to be tighter than it was, and that mispricing took prices really high. And as they say, the best cure for high prices is high prices. And so we've seen a significant cutback in demand on potash the last 2 years. The market has had to readjust price since then, and we've seen a significant decline from peak pricing on potash now to a relatively affordable level. So looking forward, I mean, I keep potash pretty simple because it is a fairly rigid product, right? The production is relatively concentrated. I think we're all aware of that. And so the pricing is relatively sticky, meaning that we see large but infrequent moves in price. Potash really, the only issue that we're watching right now is geopolitical risk, and that's the risk that we're seeing on the Red Sea. I'm sure you've all read in the news about how the pirates hijacking vessels off the coast of Yemen. The concern, obviously, with that is that if that persists and these vessel companies aren't willing to charter through the Red Sea and into the Suez Canal anymore, now in order to get vessels from the east side of the Suez to the west side of the Suez or vice versa, you can't transit that waterway, and now you have to go all the way around the Horn of Africa. And if that happens, obviously you add significant delays to vessel shipments, you add significant cost to moving that product, and so that is ultimately a big concern. I will tell you today that I have not seen significant issues doing that. Yes, we do see vessel diversions away from the Red Sea and around the Horn of Africa, but there's still many vessels transiting through the Red Sea. Actually, I have some software that I can track vessels on, and typically when you click on a vessel and look up a vessel name, it tells you the origin and their filed destination. And most of the boats that are transiting through that waterway now, instead of filing a true destination, they've just filed armed guards on board. So they're obviously being proactive in terms of protecting those boats and stabilizing the situation. But all that to say, the other reason that I don't see an immediate need to be super concerned about that situation is that the freight market isn't concerned. So we track Supra, Handy, and Panamax cargo rates, vessel rates, and those freight markets haven't responded dramatically to the upside. They did before Christmas, and now they've consistently seen decline in Handy and Panamax rates and Cape rates. And so my logic there is the people that know the ability to transit those waterways the best, the people that know the vessel market the best are vessel freight traders. And the market really isn't concerned, even when you look out on the futures curve. So although we're concerned about this issue impacting potash prices, I don't think that means you need to run out and fill up and load up on potash today. It's something to be aware of, but I do think perhaps the situation and its impacts are a little bit overblown. Obviously, that could change day to day. So ultimately, we've seen winter fill values released last week on potash. They're down just slightly above summer fill levels. So I would recommend calling your retailer, your ADM rep, and finding out what those new potash values are. We see very little movement in terms of potash prices moving forward to spring. It'll be very difficult for the market to raise price. Alternatively, because we're butting up on cost of production at a number of plants, it'll be very difficult for the price to drop dramatically further. So if you still have potash needs you need to buy for 2024, you can feel relatively secure purchasing that today, and likely there'll be relatively little movements, obviously holding the situation in the Red Sea constant. Sulfur is a very interesting product right now, and I really put sulfur up here, but I'm going to talk really about AMS and elemental sulfur. So AMS supply, the U.S. produces a sizable amount of AMS. We also import product. Canada produces a sizable amount of AMS as well. And we've really seen significant production issues. We've lost that production, so declines today in the ammonia market won't make up for production that we should have seen come to the market in November, December, et cetera. So we've seen a significant tightening of the balance sheet on AMS. This has caused AMS prices to increase significantly, and I don't necessarily mean AMS prices per ton. When I think about AMS prices, I think about dollar per pound of sulfur, right? So you take your AMS price, you price out the nitrogen. Obviously, AMS is 21% nitrogen, so you price out the nitrogen at whatever urea cost is, which today is something like 65 cents a pound, and then what are you left with? And typically when we look at pricing out that sulfur and what is the true cost of the sulfur in the AMS, we see that trade anywhere from, say, 10 cents to 40 cents per pound of S. Right now, we're butting right up on the high end of that range, right? We're looking at like 37, 36 cent cost AMS per pound of S, which is quite expensive. My concern is that the price is correct, meaning that the balance sheet has tightened up so much because of this lost production that although the price is high, I'm not sure it solves itself. And really, that's the Canadian producers, and we do produce a lot of AMS, they haven't shut down, right? They've continued to produce, but because the U.S. is so tight on supply, the Canadian producer will happily find export opportunities if our Canadian price drops to too much of a discount to the U.S. market. And so you'll typically, I would expect what is today, you're going to expect the AMS market in Canada to trade at a discount to the U.S., but if that discount gets too wide, wider than the transportation cost to export, those tons that are being produced in Canada will get sent to the U.S. And so it's important to understand that although AMS is expensive, we're unlikely to see significant declines in that price level. And if we were to see, for some reason, a significant increase in urea pricing, obviously it would start to make that per pound of S dollar cheaper, and that would add even more stability to the AMS market. So it is a relatively flat market, given we're butting up on the higher end range of what the dollar per pound of S is. But it does seem like a very firm market, given the lost production. The other sulfur product that I wanted to talk about briefly, and we to be frank, we don't really sell a whole lot, but we can, is elemental sulfur. So elemental sulfur is derived from molten sulfur. Obviously, it's a quarterly settled contract in Tampa, and we typically see elemental sulfur, so like your 85% bentonite or your 90% bentonite products typically follow, the price of those products typically follow your molten sulfur cost. Beginning of January, we saw a significant reset, as you can see on the graph, in the cost of molten sulfur. And so now we're seeing elemental sulfur as it's being repriced according to this molten sulfur pricing as an input. We're seeing elemental sulfur trade at a fairly steep discount to AMS. And so if you're an elemental sulfur user or you have the ability to switch from AMS to elemental sulfur, there are some savings when you look at it per pound of S to switch to a product like that. So I just wanted to point that out. Phosphates, I've kept this one relatively short as well. Basically, we've seen significant supply constraints bringing phosphates into North America as a whole. So the supply constraints we expect will limit backwardation in phosphate prices going into spring. We see very little reason for the phosphate price to get cheaper. To be frank, we also see it quite challenging for the phosphate price to rally significantly harder because we are starting to butt up against demand destruction. And so the market today, when we're talking about phosphates in that high $10,000 a ton, 1090, 1100, whatever it is, it seems to be priced correctly. It seems to be finding some convergence between supply and demand. So the U.S. market has countervailing duties on Moroccan, Russian, and Chinese supply that are preventing in mass that product coming to the U.S. And then the Canadian market obviously has tariffs or duties on Russian supply. And so the supply situation in the U.S. has changed dramatically since 2018, 2019, 2020, when these duties started to come into effect. And really that's what's leading, or really that's something to consider when you're thinking about the phosphate market. As we look forward to summer reset or fall pricing, we do expect a decline in phosphate prices after the application season is over. That's due to a declining ammonia market in terms of price, which is obviously a key input in ammoniized phosphate. And it's also due to a decline in sulfuric acid, like I talked about. That product peaked $110, $120 a ton and is now declining. So those two key inputs that go into phosphate production, they are declining, so that should start to abate or at least limit or exasperate, I suppose, the reset price that we see on phosphates as we get into next year or into summer. Chinese exports policy will play a key role in setting phosphate prices in the last half of this year. I have slides on Chinese export policy in a minute, so I'll skip over that and I'll talk about that in a minute. The other thing to consider, DAP is discounted to MAP. This is typical because MAP is a premium product. It requires a higher end phos rock to produce. There's less production of MAP around the world than DAP. It's just a little bit of a stickier market. So DAP is discounted to MAP, but it is a relatively salty product, so I know it's not very widely used in Western Canada. The other thing to consider is TSP is relatively affordable. TSP is trading at a discount not only to MAP, but also to DAP. So if you have interest in using TSP, it might be worth calling your ADM rep and see what that looks like. And TSP obviously has a lower salt index than DAP and probably can be used in Western Canada. The thing we have to consider is product quality, because the product quality is typically not as good as MAP. So there are options. Generally, though, given the supply situation and a few other reasons, we do see this market as relatively firm through to spring. We don't see a significant break in price. Warehouse inventories are relatively low on phosphate. I'm sure you've heard this. So this is a product that you could probably feel relatively comfortable buying today and not seeing significant price decline as we move through to spring. So our recommendation is buy your spring needs today. But it probably makes sense, given our forward price mechanism, to forward price your phosphate, given the high cost of phosphates today and the amount of working capital that you may tie up to purchase it. You could forward price phosphate today with only a down payment sort of option that abates some of the working capital. So that's really the recommendation on phosphate as we see it. Here's a phosphate graph. U.S. MAP is a premium to Brazil, just over $100 a ton premium to Brazil right now. So I just thought I'd throw that up there as well. How affordable are phosphates? There's two graphs here, and when I think about affordability, there's really two ways to quantify affordability on fertilizer. There's your simple ratio analysis, meaning how many tons of a commodity do I need to produce to pay for, how many bushels of a commodity do I need to produce to pay for 1 ton of fertilizer? I'm not a fan of that affordability metric, and really it's pretty simple. If you're thinking about $500 urea and $10 canola, or you're thinking about $1,000 urea and $20 canola, I think most people in this room would acknowledge that the second situation of $1,000 urea and $20 canola is better, but this doesn't necessarily show up in your ratio analysis because if both the input and the output double, the ratio is the same. And so really the ratio analysis assumes a 1-for-1 input of fertilizer to crop commodity, and that's just not the reality. You don't use 1 ton of urea to produce 1 ton of canola, right? The farm multiplies the input to produce a multiplied output. And so there's a multiplier effect that means that the 1-for-1 ratio analysis that's used in the industry to plot affordability is significantly flawed. We don't have a great solution to fix this. One solution is to just look at margin or net margin after paying for fertilizer. So this one is using DAP and corn. So what is the forward price on corn, assuming a fixed output? I think this is a 170 bushel corn crop. What does that produce for revenue? And then to fertilize that corn crop to nutrient replacement in terms of phosphate uptake at 170 bushels, what is the cost to do that? And you take your revenue and just minus your DAP costs, and what are you left with? And really that's what this top graph is demonstrating. And you can see a significant diversion where over in 2022, if you look at a ratio analysis of affordability, it looks very, very poor. Whereas if you look at the graph up top where we use our gross margin function, the affordability is significantly better. And I think most people would agree that although fertilizer prices were high, crop commodity prices were high enough to offset the increase for 2022 and 2023. And so affordability was relatively good. Obviously, we've seen declines in crop commodity board. This one obviously is referring to corn, but we would see the same in a lot of the Canadian crops we grow. And so affordability on DAP has declined significantly from the peaks of 2022. Interestingly, that also shows up in the ratio analysis. That's just something to consider when you're thinking about affordability of fertilizers. So put it simply, because DAP is still a discount to MAP, and that's not very affordable, you can imply that MAP is really not that affordable in the grand scheme of things. Nitrogen, so the nitrogen market is mixed depending on your time horizon of outlook and depending on the product that you're looking at. So I'll walk through quick Indian supply and demand, Chinese export policy, ammonia market changes, and then a few other issues or things to note about the nitrogen market as a whole. So 2022, 2023, I'm sure you sat in enough presentations like this to understand what was going on in the crazy fertilizer markets, and I'm sure you heard enough about European natural gas, so I won't harp on it too significantly, but obviously staggeringly high European natural gas prices in 2022 as a result of a cut of exports out of Russia into Europe caused the European nitrogen producer to have a very high cost of production. That cost of production breached market price, which caused these plants to shut down. Those plant shutdowns tighten the S&D significantly, and so you can see how logically you get from very high European natural gas prices through to very high nitrogen prices. So we saw a significant price increase, obviously, over the last 2 years. We saw production capacity increases, though, last year, and that's really what, when we look at this graph and we look at a time horizon of, say, the last year, we saw the market peak, and then a significant fall from September 22 through to spring, and then a short rally as we saw demand come forward last spring, and then now through to current pricing. So I'll just briefly walk you through this. So we've got our market peak up at the top there, and then what really happened is we saw a number of plants come online around the globe, namely in Russia, India, Egypt, and the US. This additional supply, the market didn't price correctly for all this additional supply coming online for urea and ammonia. And so in order for those producers that had this new supply come online to clear tons, market price fell substantially. Also a little bit what's going on in this large decline of urea and ammonia prices is the cure of high prices, right? High prices cure high prices, and demand was cut back. So the market decline as oversupply met lackluster demand. We saw prices bottom in about March of last year, and then obviously the US and Canada and European demand starts to come forward in Q2, and we saw a relief rally in Q2. We actually saw some nitrogen shortages in the US and Canada last year, predominantly because when the market price is declining, nobody wants to step out and purchase product to load up their terminal, and the risk is just too big, and so not enough product was forward positioned at terminals. This coupled with extremely high urea demand led to some urea outages or some urea tightness during spring of last year. So that urea tightness caused price to spike again in spring, and then obviously a sharp fall off for summer fill reset. During your summer fill reset, obviously because we had a situation where supply was really tight. Like I said, nobody wanted to position product. Ending stocks in June across North America on urea were very, very low. So the market decided to price in a reset period or summer fill reset to entice people to buy nitrogen fertilizer. But really, to be quite frank, the price was set so low that the very tight supply did not meet the extra high demand. And so we very quickly saw a relief rally in the market again when people realized that although prices were low, they couldn't buy anything. So price was not allowing supply and demand to meet. So that's why I say summer fill prices did not align supply and demand in the US due to low ending stocks. And that's really the relief rally you see over here from about July forward, right? So you saw this large relief rally that pushed prices up substantially. In Western Canada, that's where you would have seen prices touch $750, $800 a ton on urea. And then we had some geopolitical scares. So we saw some turbulence, as you can see over here. The market realized that the rally had been too severe. Demand was starting to be abated again. We saw a decline. And then we had some issues in terms of gas feedstock into Egypt, some additional geopolitical scares around Israel and Hamas that led to another short rally. And then since then, really since November, prices have been falling around the globe and in the US and Canada as well on urea. And then fast forward, that brings us to today, where we've recently, over the last week, seen a slight increase in urea pricing as demand is starting to come forward in Southeast Asia and Australia. That's, again, causing the market to work price up just a little bit. So global urea dynamics. Here you have urea consumption. Here you have urea production. I think the most interesting thing about this graph is obviously China. They're both the biggest portion of production. They're the biggest producer and the biggest consumer of urea globally. But the interesting thing is they only produce just a little bit more than they consume, and so they are a net exporter, but they have relatively little impact on globally traded urea because they consume almost all of what they produce. So they are a big player, but they're only a player at the margin in the export or tradable urea market. So it's really important then to pay attention to Chinese exports and Chinese export policy, which I'll get into. The other big player that we often pay attention to is India. India consumes quite a bit more urea than they produce, about 6 or 7 million tons. So they are a significant player. Their demand plays a significant role in setting tradable urea markets. So that's a very important market. It's also a very demand inelastic market because it is a subsidized market. So the way the Indians procure urea is through a centralized model. The Indian Department of Fertilizers has a budget every year to subsidize urea for the Indian farmer, and the urea that's brought into the country is all done through a centralized procurement model. So we have these tender organizations that basically release a purchasing tender and say, hey, we need to buy 2 million tons of urea. We want all these traders around the globe. Please submit your offers into our purchasing tender. We'll review the offers and we'll do the deals as one big trading organization. So you don't see private entities in India go out and just buy one cargo at a time. Typically, it's done through this centralized procurement model. So when we talk about an India tender, you can see why, looking at these graphs, they have such significant impact on the market pricing. The U.S. obviously consumes more urea than it produces. So the U.S. is a net importer of urea, which is something to note. And then the other big one is Brazil. Brazil consumes quite a bit more urea than it produces. It produces almost nothing. And so the big markets we typically pay attention to are Chinese exports, Indian imports, U.S. imports and exports, and your Brazilian imports. So once you look at those 4 or 5 major supply and demand pieces, you actually start to look at over half of the tradable urea market. So when we think about India, like I said, they consume more than they produce, but one thing we have been seeing is last year when I talked about a number of plants coming online that caused market decline price in urea, one of those regions that we saw a number of plants come online is India. If you look at 2023 here, you can see, and this is broke out by their marketing year, if you will, basically their planting and then consumption is the way this is broken out. So we reset. Typically, they want to load up on urea for planting in February and March, so that's why it's structured that way. We've seen a significant increase in production run rates in India of urea, which is reducing their requirement on imports. Indian consumption is also increasing, but at a slower rate. And so when you see that Indian consumption increasing at a slower rate than production, that means that their import requirements are decreasing. So this is their cumulative tender purchases year over year. And you can see 2023, we just had a tender that closed last week or 2 weeks ago that you probably heard about. That's included in this data. So this year so far, they've tendered for significantly less urea than they did last year. It's my general expectation, given our demand outlook for the Indian market, that they're likely done tendering for this fertilizer year, meaning we won't see another India tender until March. The only thing that adds risk to that is it is an election year in India for the federal government. It's an election, the election's in May, and obviously the farm lobby is extremely important for the Indian government. The farm lobby has a lot of power politically in that country, and so we do expect overstocking of urea beyond their needs to satisfy the farm lobby, if you will. So although fundamentally looking at their supply and demand disposition, they do not need more urea, they should not tender for more urea, there is a risk that they do for political reasons. If we saw them enter the market today or tomorrow or next week, we would see upward and possibly significant upward price movement in the price of urea because significant upward price movement in the price of urea because that's going to tighten your S&D significantly. This is the same chart. We're going to touch on China now. Chinese domestic prices remain high compared to the globe. Why does that matter? Because the Chinese set urea export policy based on the spread of domestic prices to international prices, meaning that the Chinese government does not want domestic Chinese urea to be significantly more expensive than the global price. And so when this happens, when Chinese domestic urea prices breach a certain level, either in absolute terms or on a spread terms to the global market, they shut down exports. And although Chinese urea is produced by private companies, the export licenses are issued by the Chinese government. And so they have full control over the amount of exports that leak out of that country. And given Chinese can export a significant amount of urea because they produce 4, 5, 6 million more tons than they need, depending on their production run rates, Chinese export policy plays a significant role in setting market expectations around price when you look at supply and demand. So right now we have seen a relatively high Chinese premium for urea. This has started to decline. Domestic prices in China have started to decline. The Chinese crop here does align broadly with the US and Canada, so they will start planting most of their crops in April. So I don't expect a significant release or export of urea before April. But once we get into the back half of 2024, I would expect the Chinese to start exporting urea again, which should lean on global prices. And that's really what this graph provided by CRU demonstrates, that we expect 2024 exports net to be the same as 2023. So they are restricted, but they are exporting product. But most of the product will be exported in the second half of this year, not in the first half. And so in this last Indian tender, we saw no Chinese participation in this India tender, which was generally expected given that they're ramping up stocks and supplies for their planting in April and May. All this to mean that if the Chinese do decide to swing into the market earlier than expected, we could see some further downside or downward pressure on urea pricing. European energy situation, I don't want to harp on this too much, but obviously European energy has come off significantly. Alternative supply points outside of Russian imports for natural gas have been found, mostly the Norwegians, and LNG imports from countries like the US, and I see a report this morning that maybe the Canadians soon too. So natural gas supply into Europe has improved dramatically. On the bottom there, that's your starting January 1 stock levels of natural gas across Europe by year, and you can see that levels are very high compared to, say, the 10-year average. And that's causing the traders to push prices down on European natural gas because fundamentally prices don't need to be high when supply is strong and demand is abated. So the natural gas pricing in Europe today is not a concern in terms of affecting urea prices. How affordable is urea? Same principle as what we talked about on DAP. Urea is relatively affordable today when you look at a corn ratio. What I will make a point of doing, and I should have done before this presentation, is compare this to canola, and I think we'd all agree that the graph probably looks a little bit worse. So perhaps urea is not super affordable for the Canadian farmer, but it's more affordable than phosphate. Ammonia prices are declining. And you might say, well, what? No, you said urea prices have gone up in the last week because we've seen some Southeast Asian demand. Why are ammonia prices declining and urea prices going up? Well, the ammonia system, although ammonia is a key feedstock input into producing urea, the systems are relatively separate. And the big factor that's driving this decrease in ammonia that we've seen over the last 2 months is that we are expecting a Russian export terminal to come online that will allow Russia to resume exports of ammonia. So if you weren't aware, Russia's not really been exporting ammonia because the main port that they used to export ammonia out was in Odessa. And there's a pipeline that goes from the ammonia-producing areas to Odessa that got blown up at the beginning of the Russian-Ukraine war. And so they've had no access or very limited access to export markets on ammonia. This new plant will allow them to resume those exports. And so the supply situation is changing dramatically on ammonia, and that's pushing prices down around the globe. This graph, I ran this on Monday. This probably looks even softer today. And so you might say, well, no, the prices of ammonia for spraying or at my retail, they're not going down. I'd argue that they will. So if you can wait on purchasing your ammonia, it does seem like that price level will come off. The very interesting thing that we've seen, and I don't know the last time we've seen this, urea prices, granular urea prices in Southeast Asia are getting done at premium levels to ammonia. So that means that we could buy a cargo of ammonia today cheaper than you could buy a cargo of urea. And I'm not talking about per pound of nitrogen, I'm talking about per ton of product. And so we've seen this significant granulation premium on urea because there's a lot of demand for urea, but there's very little demand for ammonia right now. And some of that demand has been cut by a lack of technical demand for, say, AdBlue or melamine production because of some of the economic headwinds that we all know about. Other market considerations on nitrogen. Obviously, we talked about the Red Sea. That would also add concerns because we talked about the Arabian Gulf market, and if that Red Sea was cut off, the Suez Canal was cut off, that would add freight premiums to go around the Horn of Africa. So that is a serious concern, but like I said, the freight market is not yet responding, so I'm not too concerned today. Gas feedstock issues into Iran. Iran's had some issues procuring natural gas that's led to reduced run rates. Obviously, Iranian urea doesn't come to the US or Canada. It's sanctioned, but it all goes into one pool. And if the Iranians are producing less urea and the Brazilians still need the same amount of urea, they'll start competing against us at origins that can come to the US. So that's why that matters. We've got a very low 2023. We had a very low carryout on urea, like I talked about in the U.S. So stocks are relatively low, although improving. And then the other thing to consider in terms of the urea market is Q2 is a key demand point. So we are in a suppressed demand point right now. Prices have increased over the last week because demand is coming to life in Southeast Asia and Australia. Typically, that demand comes a little bit later, so we are in a demand lull globally. Demand really starts to come alive around the globe in Q2. We see the Australians start to buy, we see the Canadians start to buy, the Americans start to buy, the Mexicans start to buy, and so Q2 typically seasonally has higher prices than Q1, so we will get some seasonal uplift on urea prices, probably beginning March and into April. Although I do think today the market is overestimating U.S. demand, and that's for a number of reasons. Last year we had exceptional urea demand in North America. That was due to UAN being mispriced. UAN was very expensive, and so nobody bought it. Everybody switched to urea. Ammonia was very expensive, as you probably remember. A lot of people switched from ammonia to urea. Today, that's still the case, but like I just showed you, I'm expecting ammonia prices to fall, which should allow ammonia application to resume, and people will switch back from urea to ammonia. And we are expecting a decrease in corn crop acreage in the U.S. that should abate some of the demand that we saw last year come forward. And so I am not particularly bullish on U.S. demand, but it's important to take that in context with all these other things that we're talking about globally that are impacting urea prices. So my concluding view on urea, the Indian government's likely done tendering for this year, but may overpurchase due to an election year. If this happens, urea prices will go up. Chinese exports are going to be limited first half of 2024. We are expecting most of them in second half 2024. But if they do export more in first half 2024 before spring, urea prices will probably come down. European energy situation is stable, probably not so much of a concern. If we saw some major thing happen there, that would obviously change that outlook. Ammonia is seeing significant downward pressure. Globally, it will take time to translate this import price into your retail price, but I would expect prices to continue to be pressured. And carry out inventories in the US and Canada are low, which is causing some form of concern for market participants that we're not importing urea fast enough. Again, my argument against that would be I don't think demand is going to be as healthy as last year. And so through all this mixed messages that is the urea market, nitrogen market, because it's very complicated, I think you've got a little bit of time. You know, we're seeing this demand surface in Southeast Asia on urea, and so I do think that obviously market prices have ticked up $20, $30, $40 in the last week. I don't think they're going to run away on us because there's no other demand globally that's coming forward. Nobody's buying in the US or Canada today. Nobody's buying in Europe today. So I do think you've got a little bit of time. I don't think you have to run out today because prices have increased a little bit. But I do think that you should have something procured. You should have your 24 spring nitrogen procured by the time we get into the middle of March and we start to see the seasonal demand come at us. And I also think you need to stay very connected to most of the things that we've gone through here that could impact the market in the near term. So it's important that you stay connected to your ADM rep or to your retailer or to your news sources or what have you, because obviously we've seen that all these different geopolitical events impact urea pricing significantly or nitrogen pricing significantly. So overall, purchase spring 2024 needs by second half of February. Market may present opportunity for cheaper top dress tons, meaning that we do expect a significant reset on urea pricing or nitrogen pricing for summer fill. So you may be able to buy cheaper tons in June or July once we get past peak demand. But I do want to just harp on the fact that we have seen demand come forward in the last few days, Southeast Asia, that has put prices up. I don't expect them to run away. Think you can be patient, but there's obviously all these reasons we've gone through that could cause a sharp increase in urea prices. So it's a delicate recommendation, but hopefully it's provided some clarity. And that's all I have.